I'm Jackson. 2 years ago, I was that guy who thought he had it figured out. I was making good money, saving aggressively, reading financial books on weekends. I thought I was smarter than the average investor. Then 2026 hit different, and I'm not here to tell you some inspirational story about how I recovered and became a millionaire. That's not this video. This video is me showing you the exact mistakes that cost people six figures. Mistakes that feel completely normal while you're making them. Mistakes that most financial advisors won't talk about because they make money when you make these exact decisions. I've made most of them. I've watched friends make them. I've studied dozens of case studies. And the pattern is always the same. Your money doesn't disappear because of bad luck. It disappears because of bad decisions disguised as normal behavior. Let's go. I had $45,000 sitting in cash. 2024 was good to me financially. A buddy, smart guy, works in tech. He tells me about this cryptocurrency project, says it's revolutionary, says the founder is legit, says early investors are going to make 500% returns. I'm skeptical, but he's smart. He invested $50,000, says he's up $90,000 already in 3 months. So I throw $20,000 into this project. First month I'm up $11,000. I'm checking my wallet 17 times a day. I'm calculating what $20,000 becomes if it 10x. That's $200,000. That's a car. That's a down payment on a house. Third month, the founder disappears. Liquidity dries up. The smart contract is exposed as having a backdoor. The project's worth zero. $20,000. Completely gone. But here's the thing nobody talks about. That's not even the worst case I've seen in 2026. I know 3 separate people who put in their entire life savings into crypto projects. One guy $60,000 from his severance package. Another woman her inheritance from her father. One dude $130,000 from his house sale, all gone. Why does this keep happening? The crypto landscape in 2026 is absolutely infested with sophisticated scams. Not amateur hour, professional criminal operations using AI-generated deepfakes of celebrities, fake YouTube reviews, completely convincing websites. There's a project launching every single day that looks legitimate on the surface, has a white paper that sounds technical, has a Discord community that seems active, has testimonials from investors making thousands. All fake. The brutal reality. 97% of new cryptocurrency projects in 2026 are either complete scams or will collapse to zero value within 18 months. That's not me being pessimistic. That's data from blockchain analysis firms. Jackson's personal loss rule. If you can't understand what the cryptocurrency does in one simple sentence, you have zero business putting money into it. And if you're thinking, but what about the ones that do become successful? Sure, some do, but you know what the odds are of you picking the winners? It's like buying lottery tickets with worse odds. I watched a friend do this. Smart dude, Harvard graduate, works at a Fortune 500 company, has about $65,000 in a brokerage account. He genuinely believes that the market is going to rally in the next 6 months. So he doesn't just buy stocks with his $65,000. He uses leverage. He borrows money from his broker. Now he's controlling $300,000 worth of stock positions with his $65,000. Market goes up 4%. He just made $16,000. He feels like a genius. He's telling everyone at work about his massive gains. He's feeling invincible. Market goes down 3%. His account is worth $38,000. He's lost $27,000 in a 3% market move. His broker issues a margin call, meaning he needs to immediately deposit more money or the position gets liquidated. He doesn't have the money. The position closes automatically. He's locked in $37,000 in losses. But the nightmare isn't over. His broker requires a minimum account balance. He's now in violation. There's a fee. His interest charges on the borrowed money are accumulating at 12% annually. In 1 month, he's lost more money in interest and fees than his monthly salary. And here's the part that gets people. He's emotionally destroyed. He doesn't even want to invest anymore. He's traumatized. That's not just money lost, that's your confidence, your future investment returns, your peace of mind absolutely obliterated. In 2026, the leverage infrastructure is more accessible than ever. Retail trading apps make it easy to borrow money. You swipe 2 buttons and suddenly you're controlling 20 times your account size. The brokers promote this aggressively because they make money on the volatility. They don't care if you win or lose, they profit from trading volume. The mathematical reality. Studies from FINRA show that 92% of retail traders who use leverage lose money overall. 92%. Even professional traders with teams of analysts and millions in capital blow up sometimes. What makes you think you're going to be different trading on your phone at 11 p.m.? The answer: you're not. And leverage doesn't make you smarter, it just amplifies your mistakes. Jackson's rule. If you're thinking about leverage, pretend the amount you're considering risking is 100% going to zero. If you can't afford for that to happen, you can't afford the leverage. You've got $110,000 in your savings account. You're being responsible. You're not touching it. It's sitting there as your emergency fund, as your security blanket. You feel good about this. You're doing the right thing. Except you're absolutely getting destroyed by inflation and you have no idea. Here's the math that nobody explains clearly. Inflation in 2026 is officially 2.9%. Real inflation, the stuff you actually experience buying groceries, gas, and healthcare, is closer to 4.2%. Your savings account is earning 0.35%. That's it. So every single month, you're losing purchasing power. Your $110,000 is worth less in terms of what it can actually buy. Year 1, you lose $3,200 in purchasing power. Year 2, another $3,500. Year 3, another $4,000. That's a $10,000 loss without a single market crash, without a bad decision, without anything going wrong. But it gets worse because interest rates have actually moved. A high-yield savings account in 2026 is paying 4.7%. Your neighbor puts $110,000 into one of those accounts. After 1 year, she earns $5,170. You earned $0 in interest on the same amount. That's a $5,000 swing per year. Over 5 years, you're looking at a $45,000 opportunity cost just from not moving your money to the right account. This isn't speculation. This isn't risk. This is institutional theft through inaction. Banks count on people being lazy. They count on people not checking interest rates. They keep people's savings in low-rate accounts because the bank makes more money that way. They invest your deposits at 4.7% and pocket the difference. Jackson's non-negotiable rule. Your savings account must be earning at least 4.5% in 2026. If it's not, you're literally volunteering to lose thousands of dollars. This isn't about getting rich. This is about not being stupid with money you've already saved. You've got $100,000. Maybe it's from years of saving. Maybe it's an inheritance. Maybe it's a bonus and severance from a job. You have an idea. A good idea. You believe in it. Your friends believe in it. Everyone says, you should totally start this. So you quit your job. You bet everything on making this work. Month 1, $22,000 spent. You've got nothing to show for it yet. That's normal. Month 4, you're down $55,000. You haven't made a single dollar of revenue. This is still normal. Startups take time. Month 8, $100,000 is completely gone. You've got zero revenue. You're now borrowing money on credit cards to keep the lights on. You're eating ramens. Your family is stressed. You're stressed. Month 11, you realize the business isn't going to work. Not because the idea is bad, it's actually pretty good, but because you were running out of cash the whole time and making desperate decisions. You started chasing clients that don't fit your model. You discounted services to the point of losing money. You agreed to terrible contract terms just to make a sale. The business dies. You've now lost the $100,000 and you're 6 figures in debt. You spent 2 years building something that didn't work. You're behind where you would have been if you just kept your job. Here's what 85% of startups do. They fail within 5 years. That's not pessimism. That's published data from the SBA. But you know what the successful founders do differently? They don't bet 100% of their net worth on day one. The successful founders keep their day job. They build at night and on weekends. They prove the concept works before they go all in. They might spend $8,000 to learn whether the market wants their product. Then they scale up. The failed founders bet everything immediately. Jackson's startup rule: never risk more than 15 to 20% of your total net worth on a single business venture. And build it part-time first until it's actually generating revenue consistently. You own a house. You've paid it down. You've got $180,000 in equity, real money sitting in real estate. A real estate investor friend tells you about this amazing opportunity. A rental property. It's in a neighborhood that's about to boom. The numbers look perfect. You run them. $2,000 a month in rent, $1,500 in mortgage, $500 net profit every month. You do a cash-out refinance. You pull out $170,000 from your home equity. Combined with your savings, you've got $220,000 to work with. You buy the rental property for $350,000. You're 30% down. Looks smart. Looks safe. Month 1-3. The numbers work exactly as planned. You're netting $500 a month. You feel like a real estate investor. You feel smart. Month 5. The tenant stops paying rent. You follow the legal process to evict. That takes 3 months where you're paying the mortgage and getting 0 rent. Month 8. Tenant's gone. But the property needs repairs they didn't report. The floor has water damage. The HVAC is shot. That's $14,000 out of your pocket. Your savings are gone. Month 10. Your primary residence needs a new roof. $12,000. You can't pay it immediately. Your cash flow is tied up in the rental property. Month 12. You get an emergency health situation. You need $10,000 immediately. You can't access your real estate equity quickly without refinancing or selling. You end up putting it on credit cards at 21% interest. Now you're carrying credit card debt. You've got a mortgage on a rental property. You've got a mortgage on your primary residence. And your cash flow is negative because the rental tenant is not paying. This is how people lose 6 figures in real estate. Not because real estate is bad, but because they leveraged 90% of their net worth into illiquid assets, didn't maintain emergency reserves, and got caught by something unexpected. Real estate in 2026 has some serious headwinds. Property prices are inflated compared to historical averages. Mortgage rates are higher than they've been in years. Rental yields are terrible. You're lucky to get 4% cap rate in most markets. Vacancy rates are rising in many cities because of rising interest rates. Jackson's real estate rule: buy with 20 to 30% down maximum. Keep at least 6 months of expenses in liquid cash outside of real estate. Never leverage more than 50% of your net worth into real estate. So we've covered 5 different ways Americans are losing 6 figures in 2026 right now. Crypto scams, leverage trading, wrong banking strategy, startup overextension, real estate over leverage. They have one thing in common. They all feel normal while they're happening. When you're in a crypto project that's up 40%, it doesn't feel like a scam. It feels like you found something special. When you're using leverage and making $16,000 on a 4% market move, it doesn't feel dangerous. It feels like you're finally winning at investing. When you're holding money in a 0.35% savings account, it doesn't feel like you're losing money. It feels safe. When you're in month 3 of your startup with no revenue yet, it doesn't feel like you're failing. It feels like you're in the building phase. When you're carrying a leverage of 70% in real estate and the cash flow is positive, it doesn't feel like you're over-leveraged. It feels like you're building wealth. That's the danger. Financial disasters don't announce themselves. They feel invisible until they're catastrophic. Here's what I want you to do after this video. Look at your financial life right now. Are you sitting in a savings account earning 0.4%? That's a mistake that costs you thousands. Fix it today. Are you thinking about using leverage or options trading to amplify returns? Remember, 92% of people who do this lose money overall. Are you considering betting your entire net worth on a startup? Wait until the business is making money first. Are you thinking about buying rental property with 80% leverage? Don't. Keep reserves. Are you interested in some crypto project that your friend told you about? Research it for 2 weeks. If you still can't explain what it does in one sentence, don't put money in it. These aren't rules to make you conservative. These are rules to keep you from joining the millions of Americans who lose 6 figures silently, then never recover. The comments section is about to be insane. I can feel it, because thousands of you are going to recognize yourselves in one of these 5 methods. Some of you are going to be uncomfortable. Some of you are going to be angry at yourself for past decisions. That's okay. That feeling means this video matters to you. Drop a comment. Tell me which mistake resonates with you most. Tell me if you've made one of these mistakes. Tell me what you wish you'd known sooner. I read every comment. Not exaggerating, I read them. And your stories help other people make better decisions. I'm Jackson. Thanks for watching real financial content. See you in the next one.